Hi everyone. What if I told you that India, after decades of relying on just two stock exchanges, is about to get a new one? Yes, you heard that right. It's not every day that you have a new stock exchange opening in the market. In a market where almost all trading happens only in one place, that is NSE, even a small disruption can change how prices are discovered, how costs are set, and how investors tend to participate in this market. So why is a new stock exchange suddenly entering the picture? And why should even investors care? Let's break it down a little for you. There was a time when India actually had many stock exchanges. This is before electronic trading. India had almost 20 regional stock exchanges. This is Delhi Stock Exchange, Madras Stock Exchange, Calcutta Stock Exchange, Ahmedabad Stock Exchange, and many others. Trading was fragmented, mostly manual, and and liquidity was like spread thin across cities. As technology improved, investors naturally moved to platforms that were faster, cheaper, and more reliable. So that's why you find defunct Delhi Stock Exchange and other buildings in the city, like Delhi Stock Exchange actually is at Daryaganj. If you go and you'll see it's a defunct building. Over time, trading volumes concentrated in just two stock exchanges, the National Stock Exchange and the Bombay Stock Exchange. So you have now a market which is a duopoly market. So India now has a duopoly market only with two stock exchanges. This structure brought about efficiency, deep liquidity, but it also meant that the almost entire market depended only on two main institutions. Now, after decades, that duopoly is being challenged and by an exchange called as the Metropolitan Stock Exchange. Once considered irrelevant, is now being revived and in a very deliberate way. Between December 2024 and August 2025, this Metropolitan Stock Exchange has raised 1240 crores. Now, the amount may be okay, but what's more important is who's invested in them. This has been backed by investors like big brokers like Zerodha through Rainmatter, Grow, Share India, and major banks such as SBI, HDFC, and Axis Bank. Now that's very important with big investors like this coming and backing a stock exchange. That means there is serious business. When leading brokers invest in an exchange, they bring in just more than money. See, money anybody could have invested. But what's more important is that these new brokers bring in technology, market expertise, and most important for an exchange to survive, liquidity. Order flow coming into the stock exchange, which is the main bread and butter for the stock exchange to survive. So with Grow and Zerodha coming and supporting this new stock exchange, this is likely to change the way the market works. The relaunch also starts with 130 actively traded stocks in the market beginning in a few days on January 27th. To avoid the mistakes of the past, the exchange is running on a liquidity enhancement program which will appoint professional market makers. Now, market maker is actually a dealer who will stand ready to process any buy and sell orders at any time in the market, right? So anybody entering the market will get liquidity, which is the most important aspect for any stock exchange to survive. There are also some interesting facts to talk about. On 1st of February, which happens to be the budget day and happens to be Sunday, National Stock Exchange and Bombay Stock Exchange will be closed, but the Metropolitan Stock Exchange will be open. So investors wanting to trade on any big events that may have arisen on the budget day can do so on the Metropolitan Stock Exchange. So National Stock Exchange and Bombay Stock Exchange miss that out. In fact, to attract traders, the Metropolitan Stock Exchange is offering the lowest transaction charges, particularly in the area of currency derivatives, an area where the cost actually significantly matters, especially for the active traders. From a systems perspective, this is not a legacy old technology that they're being bringing in. The exchange is going to run on high speed, low latency trading infrastructure. Now, what does that mean? That means that the technology that it's running on is designed for modern electronic algorithmic trading, which is what Today, 80% of the market is running on. So therefore, the exchange is ensuring that their systems are already in place to attract the algorithmic traders who can then provide the volume and the liquidity to the market. Looking ahead, the exchange is also exploring something very new. They are bringing in new products, things like carbon credit trading, which is going to be aligned to the India's environmental markets too. Now, all of this is very interesting, but how does it matter actually, or what does it mean for the CFA Level 1 candidates, or even for an average investor? In the short term, frankly speaking, very little changes. Investors will still trade where liquidity is the deepest, so NSE and BSE is going to survive. And the returns on the assets are still going to depend on fundamentals, they are not going to change. It's not going to decide as to what exchange that the asset trades at. The prices will still be decided by the fundamentals of the asset. But structurally, this matters. More competition among the stock exchanges is surely going to lead to lower costs, better technology, and reduced concentration risk. See, at the end of the day, stock exchange is a business, and stock exchanges survive on the technology. Any glitch in their systems can create a problem for the investors. So the good part would be that if you have multiple stock exchanges, like in the US, you have multiple stock exchanges, this provides a more competitive framework and ensures that this duopoly gets challenged. So the liquidity in the market will probably increase. The more competitive framework will reduce the costs for the investors to trade in. But the key question here is to ask whether Metropolitan Commodity Exchange will be able to attract the liquidity and survive the market or not.